Indemnity. It sounds sinister, but it's nothing to be afraid of. In fact, indemnity is the main function of insurance. To indemnify someone is to repay them following a financial loss. Another way to say it is to make them whole. Indemnity is a promise from one party to another. Party A agrees to reimburse Party B when Party B suffers a financial loss. In exchange for this agreement, Party B pays Party A a fee, which we call a premium. Sounds a lot like an insurance policy, huh? When you buy home insurance, your insurance provider is agreeing to indemnify you if you experience certain losses. Those losses can be damage to the home, theft of your property, a negligence lawsuit filed against you, or anything else that your policy covers. In exchange for this agreement, you pay the insurance provider a premium. Now, indemnification doesn't always come in the form of cold hard cash. Let's look at some examples to see what indemnification can look like in home insurance and why it's worth it. Indemnity takes many forms. When you make an insurance claim, it's up to your insurer to decide how they're going to indemnify you. Example number 1, repairing damaged property. Let's say your home siding got damaged in a windstorm. The total cost to repair the damage will be $5,000. If your insurer decides to repair the damage, you wouldn't have to pay for the repairs yourself. Instead, the insurer pays for a contractor to fix the siding, and you only have to pay your policy's deductible. At that point, you'd be indemnified. Example number 2, replacing damaged property. When it comes to contents coverage, it's rarely worth repairing damage. Replacing it is the way to go. Say there's a fire in your home. Your home insurance would pay to repair the damage to your house. But what about all your burned or smoke-damaged clothing and furniture? There's not much you can do to repair them, so your policy would cover replacement of those items. Indemnification via replacement. It normally means that your policy will pay to replace damaged items with new ones of similar kind and quality. Your TV may be 10 years old, but if it was top of the line when you bought it, it'd be replaced with a new TV that's similarly top of the line now. Now, our last example of indemnification in home insurance: cash settlements. Some stuff just can't reasonably be replaced. For example, if you own a set of antique bone china dinnerware and it gets destroyed, a new set of dinnerware wouldn't be an effective replacement, even though it's still dinnerware. Collectibles and antiques are about the item's value, not what it's used for, so they're almost always impossible to truly replace. Where are you going to find another set of the same antique china? Instead of trying to replace such things, your insurer would indemnify you by paying you the cash value of that item. These are just a few examples of how the indemnification process can play out. If you check your own insurance policy, you can see exactly how your policy would settle various types of claims you might make. If you want to read more about the ways insurance can indemnify you, check out the links in the description below. Thank you for watching, and I hope you found this helpful. Indemnity take... Scene 2. It's rolling, it's rolling. Make that money.